The shocking truth is revealed. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, we just got some leaked government data which proves why both the Federal Reserve and the U.S. Treasury just made a sudden pivot. We'll show you what the data is and why both agencies are so eager to front run it, because what it suggests is the next financial crisis is right around the corner. Plus, we'll show you what it means for the broad economy and, more importantly, the equity markets. Now, let's head over to Bloomberg, where we're going to give you a little backstory first before we get into the data with a headline. As Larry Summers says, the more we learn, well, it's not really true that the more we know. And this is absolutely the case with both the Fed and the U.S. Treasury, because what they want us to believe is the financial system is sound and there's nothing wrong with it. But yet, when we get in behind this data, you're going to find the financial system is in far worse shape than they want you to know. And inflation may not accelerate, he suggests, as he warned that the strong dollar may be masking the extent of inflation. And right now, that's keeping the Fed on hold, as we learned just last week. Everybody focuses on the transitory negative factors that are elevating the inflation rate, and yet nobody focuses on the transitory factors that are flattening the inflation rate. And this is important because what did we learn from Fed Chair Powell's press conference this last week is that he seemed a bit nervous. We're going to take you into the press report here in a moment, but he seemed eager, that he needed an excuse to lower rates. But the problem with the Fed, and this is a problem in every cycle, they box themselves into something like inflation targets, and we know it is one of the most lagged pieces of data the government issues. But when we look at the current data and you see what's actually happening, well, you'll see it's outright frightening, and it makes perfect sense why the Fed wants to cut. But yet we're going to see, as Larry Summers suggests, that option is going to come available, but maybe a little later than the Fed wants. Here we can see the consumer price index in blue against the Japanese yen to US dollar spot exchange rate. And what he's suggesting is the periods of a rising dollar, here you see in the red line going up, well, it means that at some point inflation comes down. And we can see this happening throughout the cycles. We know it'll happen here kind of in the late to the 90s. We noticed, of course, a dollar rally that brought inflation down. It happened again going into the dot-com bubble. And yet, even one more time, we notice heading into the global financial crisis, which we see here, of course, inflation came down, then surged due to energy costs. We'll talk about that too a little bit later in the show. And we can see this happening over and over. And right now, we see the Fed's change in tune about inflation. And there's a big reason. It's because of the dollar, and also because there's some underlying problems now in the banking system. We'll show you this data that they really don't want anybody to pay attention to. I'll even show you how they covered it up, which is absolutely brilliant. And taken together, all this adds up to a concern that the Federal Reserve may be just a bit too satisfied with where things are. Here's a quote from Larry Summers. "I think the chair is making a mistake," he said, about being more confident about policy than is warranted, suggesting that a big shift is going to happen here. And one thing that you shouldn't be making a mistake with, and that's your trading account. I want to show you what's happened here. On Thursday, we had a 100% success rate. That means anybody who bought our reports and bought every one of our trades made money that day. And I know you think, well, Steve, that's just one day. That's no big deal. But let me take you back over the last couple of months, because something I want you to understand. Professional traders, they barely even have a 50% hit rate. And look at this. Back from March 11th, if you took every original trade as of close of business Friday and you did nothing else but buy every one of them, you have an 83% win rate. And look, we're not asking you to do what a lot of my competitors want you to do, look at charts and candlesticks and all these other weird things. We ask you to do a couple things. That's follow the reports, put your trades in, control your risk. If you get out of some, chase the winners and keep waiting for new signals. And we even give you the tools on how to use the reports to manage your biggest asset. That's your 401k and your retirement IRA. And how do we do that? You want to follow the machine positioning? Well, we teach you how to get in before the machines do and out before they do. That's called our CTA Timer Pro report, but we do something unique the machines don't do that gives us the edge, a historical overlay. We give you videos. Even on Saturday today, we give our subscribers a video going through all the recent trades and the ones coming up for the week. We show you where to put your stop losses. We give you all the details. Maybe you like to trade, of course, the technicals like everybody else, but you find yourself getting in late, out early, and all over the place. That's because you're not aggregating the signals together right. We do that on top of the fact we give you a proprietary overlay that cleans the signals up, makes them smoother, and then we add a video and we make it so easy. And unlike all my friends who want to charge you for the first month, we make it free, 30-day trial. You can be successful. Again, you don't have to be an expert. Let us do the heavy lifting. Links in the description below, because let's look at the Fed statement here. And it's not the first part of this or even the second part. It's the last sentence that matters. The economic outlook is uncertain. And the question becomes is what is driving the change in Fed positioning? Because we've been hearing that we're in a no landing or maybe soft landing scenario. The second half of the year is going to boom. Everybody's piled into the equity markets, believing that we're going to see this huge bull market, this booming economy. And yet all of a sudden, we're supposed to believe that now things are uncertain from the Fed's perspective. And what is driving this? Well, is that data that they don't want you to know about. Of course, they don't even mention it for good reason. They go on that meeting to make a change in policy. The committee will continue to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities. However, starting in June next month, the committee will slow the pace of its decline in security holdings by reducing the monthly redemption cap from 60 to 25 billion. Now, why would they do this all of a sudden? Well, that has everything to do with the banking system. Because remember, this is an asset swap. So they've been dumping treasuries back into the market that's been keeping rates elevated. At least that's the market's perspective about how QE works. Real actual studies show it doesn't really have much of an effect, but what matters is how people react to this. The issue here is there's a problem in the banking system, and the Fed can use QE to control it. And so all of a sudden now they're eager to cut back the pace of it. And it's all because of this one little data series right here. Let's take a look at this. This comes from, of course, the weekly banking data. And excluding foreign deposits, the picture was just as farcical, with seasonally adjusted domestic deposits rising 126 billion. Now, keep in mind that government adjusts data all the time. Now, if you look here, you see this big drop. We're looking at seasonally adjusted in blue and non-seasonally adjusted in red, and this is going into tax season. So what happens here is as people have to pay their estimated taxes and their final tax bill, what you see is cash leaving the banking system. This is completely normal, but the banking system here needs money, and it needs it desperately. And a lot of people believe because of quantitative tightening, it's causing money to exit the banking system. So you see the Fed's position here. We can't cut rates because inflation's too high. However, we're going to actually drop the runoff of our balance sheet more than even the experts predicted. But that's not the surprising part. It's the issue that happens after this, because on a non-seasonally adjusted basis, domestic deposits tumbled 36.7 billion, including, look at this, small banks down 29.5 billion. This is a huge issue because this is where the entire problem right now in our banking system lies. And what you see is a massive revision here. And this is telling the public, if they look at the blue line, which most people look at that seasonally adjusted data, says everything's healthy. The reality is we shouldn't continue to see a drop, particularly out of the small banks. And it starts to make sense now, because what is the issue the small banks are facing? Well, they have this little bit of thing called a loan. And back during the pandemic, and we saw after that, the Bank Term Funding Program came online, and this is where banks that needed cash could trade their illiquid treasury securities for cash, but it was a one-year loan. Now the problem is this whole program is ended and banks have to pay it back. And you can see this part here that I highlighted yellow. This is where banks were running an arbitrage scenario where they were borrowing from the program because the rates were actually lower than the prevailing rate, and they were making interest on the spread. The issue now coming forward is the banks have to pay this back. Now, where are they going to get the cash to rebuy those securities back when they're hemorrhaging cash. Do you see the issue here? Because banks make money on the interest rate spread from what they lend versus what they pay out in deposits. And this is a problem because what we see here is its Bank Term Funding Program. Banks are going to have to continue to pay this back. It's sitting at $125 billion. Money we know they don't have, as of course deposits are still leaving. And one of the problems is they're not creating deposits because they're not lending enough. Here we can see commercial industrial loans at all commercial banks remains in contraction. It's been hovering right around minus 1% year over year. And what this says is banks are unable to actually originate enough new loans against the loans they're paying off. Now, the beautiful thing about our banking system is when you have a positive net creation of loans, you have a positive creation of money. Because anytime a bank creates a new loan, this being a commercial bank, not your local credit union, but a commercial bank, they create money into the economy. The problem is, as you make a principal payment back, whether it's a regular monthly payment, quarterly, or just to pay the loan off, that money is destroyed from the banking system. And right now, you can see why the Fed made a quick shift here on the QT program, because they couldn't cut rates. And they need to, because they know the banks are losing deposits and they have to pay this loan back. And there's no answer because it suggests bank failures are coming soon. And now it makes perfect sense why, of course, we see this headline as quarterly debt sales steady as details as buybacks start. Of course, this is the first time since 2002. We mentioned the treasuries behind this move as well. And for good reason, because what is the issue the banks are seeing? They're losing deposits because they have low yielding treasury debt that they cannot earn enough interest on to pay against prevailing rates where the Fed has set them. So you see the issue here is the Fed is actually pulling money from the banks by artificially driving rates too high. That means, of course, deposits continue to flow out. So the Treasury said, look, we'll come in and we'll swap you your debt. No problem. This would be great. Then you can earn more interest on it so you can pay your depositors more. And this is a key point because when we look at this, when you see periods where commercial industrial lending is in contraction, just like it is now, you do tend to see a downward acceleration in deposits, as we see here in the red line, and that is dangerous from the banks. It tells us they are on the cusp of seeing the next financial crisis. And we note that Republic First was just now the first bank this year to fail, and they're a pretty small bank. But could you imagine if it gets out of hand? Well, the problem is the Fed, as I started the show out, has boxed himself in a big way. And here we see Fed's Goolsbee says jobs report is solid and we need to see more like it. Well, Goolsbee, we actually don't need to see more like it. In fact, this is not a headline issue of the non-farm payroll report. It's the underlying issue of the report that's the problem. As payrolls and wages continue to slow over the coming months, then rate cuts are likely to come sooner than later. This from, of course, the chief economist at High Frequency Economics. We need to see more data to understand whether this was a blip or the start of the new trend. And so the Fed needs an excuse to lower inflation. Larry Summers says, look, the dollar is going to give it to you, but not quick enough. The experts are saying, well, maybe it's wage growth. And yes, there is some truth to that, because normally when wage growth is tumbling down, like you see now here, looking at average hourly earnings of production and non-supervisory employees, this showed in red on a year-over-year rate of change against the federal funds rate. Usually the Fed is starting to cut, but historically the problem here is average hourly earnings are too high. The Fed's afraid to do it, simply because they think inflation is coming back. But what they don't understand, it's about the energy markets right now. We talked about at the beginning of the show what this means for the economy. Well, nothing is good, nor is it for the stock market. As we see, OPEC Plus may need to tackle oil capacity conundrum next month. Now remember, they've been cutting, of course, their capacity to drive oil prices higher. But look at this. We see here that Saudi Arabia is already holding significant levels of spare capacity, and global oil demand growth is poised to slow this coming for next year. This is a problem because what it means is demand is going down, and that means inflation's coming down. And we can see that is evidenced on this chart here as we look at the consumer price index. And now in red, instead of just average hourly earnings, we're going to multiply that by average weekly hours of production and non-supervisory employees to look at total compensation. And then we're going to overlay U.S. regular all formations gas price in blue, or not in blue, but in green. And what I want you to see here is as wage growth slows, as total compensation declines, you naturally see inflation come down with it, which makes perfect sense. But here we see these blips higher of gasoline prices, which everyone runs and says, hey, that's inflationary, until something else happens, which means as it runs into the discretionary spending ability of consumers, that leads to lower inflation. And if consumers have less ability to spend, that means banks aren't going to lend to them either. And that's a problem because banks need to lend because we need money creation to happen. And now you see it's happening also on the consumer side, as they are going to turn away from borrowing money. And what does this mean for the equity markets? Well, soft U.S. jobs raises sell-off risk. This from, of course, Bank of America, one of the best strategists on the market. This is Hartnett speaking here. But how about this? Salary and profit outlooks even threaten the S&P's 500's 20% rally. But does it? Well, we look at this on Sunday and come back, tune in on Sunday as we look at, of course, the technicals, momentum, and machine positioning to see where the markets are headed. But one thing everybody seems to have in agreement, that rate cuts are actually bullish. And sure enough, investors are clamoring to do that. With U.S. economic growth falling to almost two-year low last quarter, inflationary pressures lingering, and uncertainty over interest rate cuts, the bar now has been raised for corporate earnings growth. You have to substitute something else if you're not going to get those rate cuts. Well, that means layoffs. It has to be guidance, because that was else is there going to be. Well, of course, the Fed is going to guide. But look at this. We know that usually as the Fed looks toward that rate cut, investors pile into equities. We see almost what is a double top scenario, suggesting we can actually see equity prices get back to, or maybe even break, recent all-time highs. But the underlying issue here is if we do see a banking crisis, that means the Fed's going to cut and cut more. As we can go back to this chart now and see what happens when the Fed starts to cut. See, the market believes, oh, we just need a couple cuts and everything turns around, only to find out that's not actually what's happening. The Fed actually is cutting because the economy is slowing. They broke the back of it. And sure enough, that is what we're likely to see again. But it's really what's going on in the banks right now. They're seeing deposit outflow. That's why the Fed and the Treasury are eager to make that change. It's all because the government wants to seasonally adjust some numbers in a big way to make everyone believe that their bank is safe. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.